Hi, everyone. Welcome to the a16z podcast. I'm Sonal. There's a lot of talk about cryptocurrencies and tokens and ICOs out there, but beyond the hype, why does it all matter? It turns out the internet, believe it or not, given all the things that are already built on top of it, is just the beginning. And as we enter a new phase of blockchain-enabled innovation, there's a lot more to come. So in this hallway-style conversation, we break down the fundamentals you need to know on the topic, from incentives, networks, developer communities, and new models of governance, to the trade-offs between centralized and decentralized systems. And then we briefly touch on how to tell the difference between what's promising and legitimate versus a red flag when it comes to ICOs, as well as valuing tokens. The two guests on this episode covering all of this are general partner Chris Dixon, who shared his thoughts about the topic on Medium, as well as on our podcast before. You can check out those episodes. And Fred Ehrsam, who did computer science at Duke in undergrad, was a foreign exchange trader at Goldman Sachs in New York, and is a co-founder of Coinbase, which has now become the largest cryptocurrency company in the world. And he's on his own now, and you can check out his posts going deep on the topic on Medium as well.
So let's go right into our favorite topic, which is what we talk about all the time, which is the cool stuff happening in cryptocurrencies. So for people that are listening and they've heard about Bitcoin and Ethereum and a few other things, why is this not just some crazy internet speculative thing? Like, why does this matter?
It matters because I think for the first time we're embedding economics into the internet.
Didn't we have credit card forms and what do you mean we had economics? We have Amazon, we have et cetera. Like, what does that mean?
We didn't. We had what I would think about as indirect economics in the sense that you could pay for literal goods and services on the internet, but the building blocks of the internet themselves were not precisely programmed and parceled out into little units that you could pay for directly through the protocol. And that's sort of what we're seeing with the dawn of Ethereum as a computational resource or Filecoin as sort of a global database resource. And there's the other aspect of it, which is they're more neutral and can make their way just into far more systems than a centralized company maybe ever could.
One way I think of it is we had this significant design constraint, we meaning the internet community for building things, right? Which is you basically had like two models. Like one was you do something as a nonprofit and it's a protocol. That's how protocols were designed in the past. And that was awesome in the beginning, right? You had, academics and governments design the core protocols of the internet, TCP/IP and HTTP and HTML and SMTP. And that was great. But then if you kind of look at the next 20 years, like how much more of that happened, right? And then you had these situations like the Heartbleed bug and SSL. So SSL is a core cryptographic protocol. Every time you go to any website, you rely on it. It's what keeps your banking information and your email private. It turned out there was a half a developer working on that project on SSL because protocols have been basically abandoned. There basically has been almost no, for all intents and purposes, there's been basically no protocol development since the beginning of the internet because there was no business behind it. And meanwhile, you had Facebook, has internet advertising and Google has internet advertising and Amazon has transactions. And they've gotten these massive flywheels going where they take all this money in and then reinvest it in technology. And so all of the smart developers and the energy and the money has gone into these highly centralized systems. Meanwhile, you've got a whole group of developers who have been, frankly, kind of abused by platforms for a decade. You just arbitrarily get banned, and if you're lucky, you get to pay them 30%, right? So there's a deeply unhappy group of developers all over the world who want a new way to do things. And it's coincided with this new way to design and monetize and protocols.
As a developer, do I want to build on a centralized platform? All of a sudden you realize that there's probably a ceiling on your head or a guillotine over your neck, depending on how you view it. Whereas in a decentralized protocol, since it's this big mutually owned entity, nobody can really come along and shut you off or limit your growth.
Well, the other thing, it's funny because people talk about, how Bitcoin was created during the financial crisis. I also think, there's another crisis happened around that time, which is the developer crisis. There was a real reckoning that happened in the developer community. And there's a generation, I think, like the new generation of developers is not going to fall for the same traps that they fell for in the past.
Fool me once.
I would argue that almost every developer platform, and by platform I mean a sort of a network where developers come together with users, and so that goes back to Windows is a platform, obviously, iOS, iPhone is a platform, Android's a platform. Twitter was a platform, Facebook was a platform at one point. Almost every platform has been characterized by massive kind of intra-platform battles, right? Mm-hmm. And so, Microsoft notoriously fought against Netscape. Every time Apple gives a keynote, there's always this list of which startups they killed. It's just a long, long history of it. And so one of the other exciting things in the kind of cryptocurrency movement is it's a new way to potentially build networks where all the participants in the network have aligned incentives and don't need to go kill each other.
That really is the key word in the whole thing is incentives. What are the incentives of the various actors in the networks? And this gets into the frame of reference that most blockchain-based people think about, which is what are the incentive structures that you set forth? And what is the likely emergent behavior that will result from that? The primary example being Satoshi comes along in 2009, drops a 9-page white paper, which is effectively an incentive structure, into the world. And years later, we have a $70 billion cryptocurrency, a whole ecosystem of companies, users, and investors involved, and the largest supercomputer network in the world by 4 orders of magnitude. So it just goes to show how powerful incentive structures are, and one that is really well engineered can just create massive amounts of emergent behavior that are almost hard to fathom at the beginning.
It's because when you layer in these incentives where the user, and the incentives, by the way, are incentives not just for the developers building the project like the way they are to startup. One of the brilliant things here is there's a whole new set of incentives that are given to so-called miners, who are the early kind of service providers in the network, and then also users of the network, right? But yeah, these set of incentives, it appears so far, can make these new networks grow at a rate that we haven't seen before. I think how quickly Ethereum grew is another example of that.
That's right. One of the ideas that you turned me onto very early, which I think is perhaps the most important idea of the entire thing, is you now are incentivizing all potential users of a potential protocol or application to join the thing early. If you look at all the value that's really accrued over the last 15 years, the vast majority of it has come from companies who have effectively built proprietary databases with strong network effects around them. So we now live in this world where there's massively consolidating power. And one of the great, I think, promises of the whole token movement in cryptocurrency is that for the first time, you can overcome the chicken and the egg problem as it relates to network effects.
The good news is once you're at critical mass, they're awesome, right?
Right.
The bad news is until you're at critical mass, they're terrible. Like a dating site with one person is like the worst website in the world, right? Yes. A dating site with 1 million people is hopefully a better website. But how do you get to that point? And I'll just tell you from my personal experience, having been once an entrepreneur and now an investor, like 99% of the networks that are attempted fail in the bootstrap phase, right? And to get over it, you go back and you ask, Brian Chesky and, the founders of eBay and all these other companies, and they always have these heroic tales of how they, through sheer force of will or clever tricks or money or whatever the thing might have been, they somehow got through it. But there's like 15 of them on the internet that are like scaled networks. And there's 10,000 others that are probably really useful and would be helpful to the world that never got through the bootstrap. Right. And so one thing that cryptocurrency does potentially is it's like a universal solution to the bootstrap problem. We call it the chicken egg problem, which is you incentivize the early users. When there's not enough network value, you give them financial value. And then eventually you give them less financial value because they get network value.
It's kind of like joining a startup early where you get more equity by taking more risk, except it applies to all the users of a potential application. So if you imagine a graph where on the x-axis it's the number of users on a network and on the y-axis it's the utility. If you're the first person on the network, the value is effectively 0. And then as more people join the network, the value goes up drastically. And there is a risk-reward thing there, just like startups, where it's possible that network won't work. But if it does, then you stand to gain quite a bit. And so goes this sort of emergent behavior of people who are now all of a sudden much more willing to either contribute to or use these networks in a much earlier stage, even if they might have less absolute utility at the beginning.
But the beautiful thing, too, is that if it works, that it's not just the employees who benefit from this appreciation, right? It's the users. And then those people also play a role in the governance of the network. I find it personally quite frustrating to read some of the news reports. One column, they'll say, we're very frustrated with how Facebook handled the election. And on the other column, they'll say, wow, cryptocurrency is this terrible thing that Silicon Valley is doing, and not realizing that the whole point of decentralization and cryptocurrencies and the entire movement that we're talking about here is precisely to address these kinds of grievances that people have with platforms. And like that's the whole point of this movement. And actually, a lot of, by the way, the cryptocurrency movement, it's not a coincidence, isn't coming from Silicon Valley. It's coming from other places. It's got very important social and economic and broader kind of societal implications.
I mean, one really interesting thing to think about is in the quote unquote real world, we don't get to try that many economic or governance models, right? Like it's not so often a new government pops up or a new central bank pops up. You can view each token as basically creating its own little central bank and its own little government. And there are already over 1,000 tokens. So in some ways, what we're doing is we're creating a giant experimenting ground for all sorts of different monetary policies and all sorts of different governance schemes.
So let's talk specifically Tezos as an example, right?
Yeah. So for those who aren't familiar, Tezos is a new blockchain that looks somewhat similar to Ethereum in that it allows you to run little bits of code on the blockchain referred to as smart contracts. But the main new feature that Tezos is creating is this idea of a self-amending ledger, which is a fancy way of saying that the rules of Tezos, the protocol itself, can be modified. In other words, the users and token holders of Tezos can vote to change Tezos itself as time goes on. And the reason this is interesting is it provides this unique evolutionary mechanism within Tezos, if you view it as sort of an organism, where it can evolve and adapt over time based on what Tezos users think would be most useful for Tezos. Through this mechanism, you can imagine developers being able to contribute improvements to the Tezos protocol and getting paid quite substantially for it.
Well, it's a shame because, like, if you look at the specific challenges that Ethereum has, you know, around scaling and sharding and other things, there's plenty of people. Like, I was just talking to some people at Stanford, and they're all like experts on this, and like they have no financial, like they weren't earlier holders of Ethereum, and yeah, sure they could pay them or something else, but these are people that are in high demand and can work on a lot of different projects.
So if you take Ethereum as an example, it's roughly a $25 billion cryptocurrency. If you're to come out and submit an improvement like sharding, for example, a working implementation, it could easily raise the value of the network 10 or 20%, which we're talking $2.5 to $5 billion. That's a really big potential bounty. So then the question becomes, well, how do you match that potential value creation with the incentives to actually go and do the thing? And that's where I think more innovation needs to happen. What if you could offer even half of the perceived value of one of these improvements? So in this case, let's say you're to offer about $1.25 billion to somebody to come along and improve the protocol. All of a sudden, everybody wins, even though the size of the bounty just seems enormous, right? The interesting thing about Tezos is the way they propose doing this is through token inflation. You submit a pull request to the Tezos code base with a bill attached to it, and the way you get paid is some new tokens are created and they're sent to you. It's kind of like a new employee joining a company where everybody's stock gets diluted a little bit, but it improves the overall value for everyone.
Yep. Let's talk a little bit about staking. I've heard this concept of staking coming up a lot more. The most obvious place it shows up is Ethereum's moved from proof of work to proof of stake. It seems to unlock greater areas of the design space. You know, like there's some new things that can be designed. You can add negative incentives in a way that you couldn't before, as an example.
Right. So it's generally a mechanism to punish bad behavior that is seen as out of consensus or untruthful with the rest of the network. And that's obviously really important because you need to punish malicious behavior.
Email is a great example where you don't have negative incentives. And so therefore you have this deteriorating spiral of just it costs $0 to send an email. You just go out and send 1 billion of them. You know, luckily spam filters have gotten a little bit better, but still it's a problem. If every time you opened an email account, you had to stake something, and whenever you sent a spam email, you lost something, that would dramatically change the
spam emails killed overnight, probably.
Yeah, probably overnight. Yeah. Okay, so let's talk about centralized versus decentralized. Let's talk about pros and cons.
Sure. So pros to centralization are you can potentially have more control over a process. Thus, if you're developing a single product or in a single line, that development probably happens more effectively. Also, from a computation or efficiency standpoint side, you can always do things more efficiently centralized.
The performance is always better.
The performance is better. Yeah. The downsides are in a centralized process, you only really get to try one path. For example, there's only one Facebook. In other words, there's one big proprietary database, and they are taking that thing as a company, generally speaking, in one direction, absent some A/B testing here or there, perhaps. You can't try 5 versions of Facebook at the same time. which could yield very interesting results. And as we've seen in a capitalist society like the United States, it turns out that when you try a bunch of different experiments, you get a bunch of really valuable things that happen that you might not have expected originally.
You're making the analogy to a centrally planned government economy versus a decentralized capitalist market economy versus a sort of a centralized economy.
Exactly. The second part, going back to what we talked about earlier, is a lot more people are more likely to be willing to use a decentralized protocol or system. So in the same way that PayPal could never really become the money of the internet, but cryptocurrencies theoretically could, or in the same way that developers are now quite scared of building on the Twitter or the Facebook API, but everyone uses SMTP or HTTP or TCP/IP as these common protocols, then if everybody's using the same standard, there's a strong network effect in that it enables much more powerful communication, much broader communication.
One criticism you hear of decentralized systems is less performant, the user interfaces aren't as good, et cetera. I would personally argue the performance and the usability critiques of decentralized systems is a red herring. Because you need to look at these things as dynamic systems that evolve over time. Yes, the decentralized systems will start off on day one having clunkier interfaces and slower performance, but they have the benefit of having all the developers on top of them. The same thing happened, by the way, with the internet versus AOL. AOL had a much slicker interface and more performant in the beginning. The internet was clunky and weird and slower and all these other things, but you had all the developers building stuff on top of it. I think the big advantage if you look at the SMT is you can build a business on email. You can build, in fact, there have been thousands of startups that have been successful that have built businesses on top of email compliance and anti-spam and email inboxes, and Microsoft has a huge email server business, and there's a lot of interesting businesses built on email. You could argue Gmail's gotten so powerful, so big at this point that maybe they've actually re-centralized SMTP to some extent, so that maybe that's a counter argument. But generally, the difference with SMTP is you can exit. As a developer, you can exit. As a user, you can exit, and that keeps the platform in check, right? It doesn't matter if you can export your data from Facebook. All your friends are on Facebook. It's a network effect. That game is over. There will be new games.
If you had to make a bet, would you bet that a centralized kind of Web 2.0 company doing a particular thing, like creating a social network, we take Facebook as an example, would win or lose in a race versus a decentralized set of protocols that was trying to accomplish the same thing?
If they were both starting from scratch, because today, obviously, these centralized platforms have a ton of money and resources and other things.
Okay, well, let's even assume the current head start that Web 2.0 companies
I think it's a very interesting question. It's a very asymmetric race. On the one hand, you have money and people focused on a team sitting in the same office, with aligned mission and everything else. On the other side, you have the power of nights and weekends versus 9 to 5. People going to work, showing up at their office. You get an organized army that marches together, that is told what to do, that has funding and resources. They have better monitors and better computers and better servers and all these other kinds of things, right? And then you have this kind of ragtag weekend militia, and there's a lot more of them, by the way. The militia is much, much bigger. The nights and weekends programmers, the people that built Linux, the people that built a lot of the internet, the people that built Wikipedia, all these people, the people that built all the open source projects, there's probably 10 million really, really smart developers, right? And so to me, it's kind of a question of, do you want to bet on kind of the British marching straight along, or the ragtag militia fighting against them? The history of this is very clear, and that the side of the nights and weekends for the last 30 years, that's been the best predictor of the future. That's where I bet. That's how I make my investments. That's where I spend my time. I have this blog post, what the smartest people do on the weekend is everyone else will do at work in 10 years. And I think it's been one of the most predictive heuristics in technology.
Yeah, you could almost view it, and you could probably guess as to where the higher intrinsic motivation levels are.
It's motivations. It's also time horizon, right? It's when you're a company, no matter how visionary you are. I mean, I think Zuckerberg and Larry Page, they're extremely visionary and they're extremely long-term thinking, but ultimately they do try to manage probably to a 2 to 5 year horizon or something, right? Whereas people on the weekends and nights and research labs, they think of about 10 years longer.
And this is where some of the innovator's dilemma stems from, where if something is crazy enough, it's too much of a risk, it's too big of a brand risk, it might not produce revenue in the short term, whatever it might be, it's less and less and less likely to be tried. So as a result, you try less things. The interesting thing about the decentralized paradigm is the ability to try many things as opposed to just one path. It would be the equivalent of being able to take Facebook, copy all of their source code, copy their entire database, and try 5 different versions in parallel. Some of those will work, some might not. You take the ones that work the most, and then you split them again. It's kind of like evolution. In these token mechanisms, things are inherently more chaotic because they're decentralized, in the same way that things in free market system are more chaotic than a centrally planned system. The thing you're betting on, though, is trying more paths. You learn pretty quickly, especially with the length of the feedback loops in the token ecosystem being so short, what paths are worth exploring, which ones aren't, and then you just continue consolidating resources and splitting out again from the things that do work.
This is what's made me the most happy about in the last year in cryptocurrency, as opposed to 2014 and 15, which were pretty wintry, and it's not the prices. People say, "Oh, the Bitcoin was down, now they're up," and it's not. To me, it's not that. It's exactly what you're describing. It's the rate at which there's experiments getting run.
I'm assuming that we'll develop better and better ways over time to both fund decentralized innovation and to foster it in a less chaotic way. Namely, we'll go from assembling on bitcoin.org and r/Ethereum to better threaded GitHub repos, or who knows what the next advancement will be. You're spot on that perhaps the leading indicator of the whole industry is developer activity and experimentation. Back in 2014, one of the main graphs we would look at Coinbase is GitHub repos that are referencing Bitcoin. And one of the really interesting things now is to look at the rate of repos that reference Ethereum. Amazing experimentation was happening again. All of a sudden, just the space of possibilities and the excitement and, to use some of your phrasing, the toying around just increased drastically.
Well, Ethereum did so many different things. Like, one, it showed that you could just simply have another scaled network, right? I think a lot of people just assumed it was going to be one network to rule them all, network effects, et cetera, et cetera. So it showed just like an existence proof that you could do another network. Number two, it's got a full, Turing complete, essentially JavaScript Solidity programming language, right? So it lets you build apps. It's got this whole kind of platform aspect to it, which Bitcoin sort of had in the beginning, but never really developed with the scripting language. And then not only do you have apps on top of Ethereum, but then it also inspired all these other new token networks. So it's almost like three axes of like innovation going on at once. It was more that fork.
It was
of
the
the
start
movement.
of a paradigm.
Yeah,
shift.
it was. I think of it as the movement forked between kind of what I would call as the financial oriented people, the people that want to create a new system of money when that's where Bitcoin resides, and the people that want to do more what we're talking about, which is create decentralized systems.
Right, which is why I think this space is so unique and multidisciplinary, right? Where if you are just a typical financier or Wall Street person, increasing the number of lenses through which you can view it drastically increases your understanding and appreciation for the power of the system. In other words, you need to understand it as currency, and that's one way to model fundamentally what these things might be worth and how certain aspects of the system flow. But if that's your only lens, then you view it just as money, and you don't get some of the intrinsic value or why this could become a new kind of global computational platform or infrastructure.
I think what they are missing is that a lot of what's going on here is new internet. It's sort of redesigning the architecture of the internet in a way that allows for the participants of the internet to own a piece of those networks, and ultimately those networks will have value, and those resources will have value, and that any critique of the value of that should probably start with an understanding of what is being built, right? And what is being built requires understanding how the internet works, both from a technical level and a cultural level. And then there's the stuff that we're talking about, which is creating a network and token, and you use that token. So let's talk about there's all this talk about ICOs, which I don't like that word, but it's the word people are using. So let's talk a little about what's going on now.
Yeah. So everyone's coming out of the woodwork selling a token because they think there's free money to be had. Just like startups, there's a small percentage that are legit and really worth funding, and there's a whole glut of projects that unfortunately are not and probably won't go anywhere.
Or on the other case, scammers are entering the space. I mean, it's just gotten...
For sure.
Yeah.
It's worth talking through what are the fundamental components or signs of something that has the initial signs of being promising or at least somewhat legitimate as an effort versus red flags. On the red flag side, a couple things come to mind. One are tokens, which we would refer to as rent-seeking, meaning they extract value from the transactions that occur through the network to the token holders or some third party, where in some ways part of the token movement is that you eliminate the middleman, and that's just totally unnecessary. A second is raising money purely for another investment vehicle, which itself is centralized. There's no reason you need a token for that.
If the token gets dividends in proportion to the company's profits, that's almost textbook security, right? And so that's also something that should be done in the traditional way.
Right. Other favorites are releasing a white paper that is actually just a marketing brochure. It has nothing to do with the technical specifications of a protocol, which is what a token does. It powers a new protocol of code.
Yeah. So the flip side of that is things to look for that are positive is there's actual running code as an example, or at least live code, or at least a very technical white paper that describes the code.
A team that could plausibly write such code.
Team with a strong software background. One thing I should say is that all of these things that we're discussing here, cryptocurrencies, ICOs, are very complicated, very fraught with risk. It's very early. I strongly recommend that people do a lot of work if they think about buying any of these things and treat it as an investment that could go to zero, and like a venture investment. And so tread very carefully. We're not in any way suggesting that people should buy any of these things, even though we're excited about them. So what else? Like, what are the other?
Yeah, well, one is maybe matching the stage of the industry with the ambitions of the project. So at the moment, I think we're largely in the infrastructure building stage. And if you look at what Ethereum is capable of in terms of just throughput of the network, it can't handle more than about 20-ish transactions a second right now, which means that you're about 20,000x off being able to run Facebook on the chain. So as a result, it's probably a lot more valuable and relevant to build infrastructure components that lets people scale that and build apps in the future rather than trying to build Facebook right now. I would assign a higher likelihood of success to systems and infrastructure rather than I'm building a massive
user-facing app. To use the analogy of the internet, we're building optical switching and web servers and all sorts of other infrastructure. There's a reason it took 20 years to get to Facebook. You had to have AWS and you had to have all these other kinds of layers of infrastructure.
A mistake that's often made in paradigm shifts is we try to shoehorn ideas from the existing world into the new paradigm because all we know is the existing world. The whole reason the new paradigm is interesting is because it lets you do new stuff, not old stuff.
Yep.
So one of the biggest things I look for, if not the biggest thing, is does this feel like a uniquely enabled behavior by the blockchain?
Is it de novo native to the blockchain? Or is it a port from a non-blockchain thing?
The car is being dragged by a horse.
It's like barnesandnoble.com, not Amazon, right? That's kind of the analogy I like to use. It's always the one that goes kind of all in, burns the boats, does it fresh, designs it exactly the right way from first principles, is not encumbered by the legacy infrastructure. So I think about that a lot. There's always this tendency to want to do the hybrid thing because it seems easier and it seems more familiar. But the hybrids never. Like you look back at the internet, like the hybrid stuff never worked. There's always the pure all in on the internet, first principles, redesign it. It's things like Stripe. Hey, what would it be like if we made like the most awesome payment system for developers and we design it from scratch?
Yeah, and
it's always going to be better that way than, hey, let's take our existing bank assets and let's hire a few programmers on the side and like make it internet like.
One thing I think is really interesting to look at is the top 50 sites on the internet today. Guess how many of them were made by companies that existed before the internet was popularized?
I mean, I don't know. What's the answer?
It's two.
Yeah.
MSN.com and Microsoft.com, both by Microsoft. Every other site is made by a company that was native to the new paradigm, i.e. started after the internet was created. I think the best example of this is thinking, okay, well, the value of PayPal is X, thus Bitcoin should at least be worth Y. Or, Uber is worth at least X, so a decentralized Uber token should at least be worth Y, or something of this nature. I think subconsciously most people think about the value of tokens like equity. And if you were to say that directly to them, they may not say, oh yeah, I think a token is equivalent to equity. But that's just how we're used to interacting with most of the financial world today. But it turns out that tokens don't really function like equity at all. The key difference is that equity represents rights to a future cash flow in a company, namely a company where you sell some products, you sell them for more than it costs you to produce them, you get a profit out the other side, and that gets distributed to shareholders.
Yeah, so when I think about the future value, I mean, right now I think there's probably like the prices are very speculative. Let's put it that way. Like the prices of cryptocurrencies.
Sure, just like anything.
Yeah, and I don't know and they may be too high. A lot of it's speculation, right? Like how do you think about the kind of long-term value?
A lot of my thinking has been influenced by a guy named Chris Bernisky, who used to work at ARK Invest, which is a Wall Street firm, and has been doing a lot of work putting together more rigorous financial models for cryptocurrencies.
You go through and you really kind of model out in detail if Filecoin got to scale and you were using Filecoins to transact and the storage market were this big and people were willing to pay this much in fiat, and like how would that, translate into the value of the token? So he's done some great work on that.
This is where tokens are fundamentally different, where in my opinion, the best tokens and the ones that really follow the token model most truly are not rent-seeking. They take a cut of all the transactions that go through the platform, for example. Just because you happen to own a token doesn't mean you're entitled to money on a process over here that, in fact, you didn't really do any work to earn. Upon closer examination, tokens more closely resemble currencies, where you look at some kind of monetary theory equation like MV equals PQ, and it turns out that the important things to look at are not the right to a future stream of cash flows. Rather, it's the money supply, it's the velocity of money, it's the average price of goods or services in the economy, and it's the number of goods or services in the economy that are sold. It might be the money supply is how many Filecoin are outstanding. The velocity is every year, how often does the whole money supply turn over? The price of goods and services in the economy could be, how much does it cost to store 1 gigabyte of data? And then the last part of the equation is, how many times are people actually buying storage for 1 gigabyte?
Yeah, you can model out, and I've seen actually pretty interesting attempts to do so. You sort of make a bunch of assumptions. You obviously have to do it because it's speculative. I would argue, though, that there are really kind of two things going on right now, at least two. And that there's sort of the Bitcoin side of the world, which is more about kind of creating a store of value, replace some kind of digital money, and almost resembles more of a commodity. And you might think of the value in it more like a commodity. And it has certain attributes, like you can send it all over the world and it's censorship resistant and a bunch of other things. And there's some value to that. And that will be modeled in the way you're describing. My personal nomenclature, like I think of in the first bucket, the commodity bucket, there's Bitcoin, there's Monero, Zcash, maybe Dash. And then there's this other thing, which is kind of the networks, call them fat protocols, call them tokens. There's this whole other sort of, which is you're creating these systems where it's a network resource. And I think you'd have a different valuation model for that.
Yeah. I would argue the equation actually that underlies both of them are the same, though. I think the commodity angle is useful from a mental model perspective. I mean, there's literally the concept of gas in Ethereum, where it's how much resource does it cost to run the machine. So in the same way you pour gas into a car to make it run, you need to supply some ether in the form of gas to run a computation on Ethereum. So from that perspective, commodities make sense. The flip side of that is usually commodities are sort of a use it and lose it thing. There are actually some cryptocurrencies that do that. There's this concept of proof of burn, and that's another thing that people are playing with. But the most common model tends to be you spend a cryptocurrency and it's not burned, it just goes on to someone else, kind of like money.
I guess I think of it as in software is the ability to encode any idea into machinery. And there's no reason why software couldn't you couldn't encode both ideas of equity, commodities, money, and new things we'd never thought of. The limit is just sort of what people can think of. This is also why the traditional models of innovation, like the Carlota Perez model, don't really work in software worlds, because in software it's bound only by the ability of people to kind of come up with new interesting ideas, and one pseudonymous person can come up with a short white paper and change the trajectory of the whole thing.
That's certainly true on the development side. I think what Carlota Perez might argue back is that describes more of how long does it take for the idea to spread through a population that needs to adopt it. And maybe the interesting thing that you're pointing out here is that just like the protocols of the internet, it may turn out that a lot of these underlying blockchain and token mechanisms start to become the infrastructure for a lot of the stuff that we use every day. And in the same way on the funding side, we'll go from this kind of crazy token crowd sale where we sell everything to better figuring out how to reward people who do work, or the concept we were talking about before, which is everybody puts up a little bit of their own money through inflation and dilution to pay for new innovations. We've had so many years of improving the theory of the firm, of the centralized company. We've had very few years and very, very little effort on how do we actually do things better in a decentralized way on the internet. So I think there's a long way to go there and a lot of efficiency gain to be had. The big challenge and opportunity for incumbents, whether it's a bank or one of the big Silicon Valley companies, is to adapt their business accordingly. And although margins and revenue opportunities in the old paradigm often compress, the opportunity set keeps getting bigger. And the surest way to fail is to assume it's a zero-sum game. It does not have to be a zero-sum game. And this is true of all technological paradigm shifts where there's a commodification of all the value creation that happened in the last paradigm. So now value creation has to happen at some new layer. You just have to have an open mind.